In this video lecture, we're going to be talking about disclosure notes that are a required part of the financial statements. Disclosure notes provide information that the users need to know regarding various key items. The first one we want to talk about is the summary of significant accounting policies. In GAAP, we are given choices in many instances, where a company or entity can choose between alternate GAAP approved methods. It's important that we disclose these to the users. So let's take a look at what the code says about these accounting policies. Again, they talk about how these are essential for financial statement users because GAAP provides alternatives and requires the use of judgment and estimates. You see here that GAAP has disclosure requirements. You have to disclose items, methods that would affect materiality as to the determination of financial position, the balance sheet, cash flows, results of operation, which is of course our income statement. Again, we disclose which method among the acceptable alternatives we have chosen, if there are particular methods that relate to a specific industry, or if we have any unusual or deviations of GAAP that are actually a benefit to the user, what's known as an innovative application of GAAP, we will disclose them. The next section talks about the things that we need to discuss, the basis of consolidation, which is something we'll discuss in advanced accounting, depreciation methods, amortization of intangibles, are things we talk about in Intermediate 2, along with inventory pricing. We'll be talking about the recognition of long-term contracts in Topic 6 in our class, along with the recognition of revenue from franchising and leasing. So here are the notes from Lowe's financial statements, and they're going to start off by talking about the summary of significant accounting policies. Let's take a look at merchandise inventory. This gives us a good example. When you value inventory, as you remember from your principles class, you have the choice of LIFO, FIFO, or weighted average. In addition, GAAP requires that the valuation be at the lower of the cost or market. So in this little paragraph, Lowe's summarizes how they record or measure the valuation of inventory. And it tells us that it's stated at the lower cost of market using a first in, first out method or FIFO method of accounting. Other disclosure requirements deal with what's called subsequent events. A subsequent event is something that happens after the fiscal year, but before the financial statements are issued. The last date of the fiscal year does not drop down a curtain on the disclosure requirements that we have. If something happens between the end of the fiscal year and the issuance of the financial statements, and we believe it is material, that is, it could change a user's decision, we must disclose that. Subsequent events are covered under topic 855 of the code, and on the overall subsection, we see that we can get ourselves a definition of subsequent events, and they give us the two other key dates talk about how and what we have to disclose, the nature of the event, and the estimate of the financial effect. And in an extreme case, we may be required to uh, revise financial statements after the balance sheet date. However, that is exceedingly rare. Additional disclosure is required when we are aware of certain risks or uncertainties. These relate to things like related parties, errors or irregularities that have been discovered, or other illegal acts. Because we use significant judgment and estimates in preparing our GAAP-related statements, there are certain disclosure requirements that we have to ensure that the users understand some of these risks and uncertainties. And that's covered in the code under section 275 in the overall subtopic in disclosure. It lays out for us the things that are required, such as the nature of the operation, the use of estimates, in the preparation of financial statements, vulnerabilities due to current newsworthy events, and they give examples of the types of disclosures that are required. In addition to disclosure notes, management must present a section that describes their perspective of a company's operations, their financial position, and the resources that they have available. In addition, in order to further reduce information risk, outside auditors look at the financial statements and express an opinion. The most common form of opinion you're going to see, and that's the case in 99.9% of the time, is the unqualified opinion. This means that there are no issues and that the auditor's opinion is that the users can rely on the financial statements. There are other types of audit reports that could be issued. These are very rare, and you'll take a look at these later on in auditing, which is pretty much your capstone accounting course. And the final document that is included as part of the disclosure is a proxy statement. As part of the annual process, there is a shareholders meeting where shareholders get to vote on certain issues that are coming before or brought before the stockholders by the board of directors. Included in these proxy statements for publicly traded companies is a disclosure regarding executive compensation and the use of stock options, and we'll be talking more about that in Intermediate 3. In addition to the disclosures for significant accounting policies, in each area of the code, there are very specific disclosure requirements. Let's take a look at the disclosure requirements for property, plant, and equipment. In every subtopic, in addition to the recognition, initial measurement, subsequent measurement, there is a disclosure area. Any GAAP required disclosure that is a separate note that is related to the item, the topic area, will be listed here. Here we see that there are specific disclosure notes related to property, plant, and equipment. We need to disclose the depreciation expense for the period, the class of assets, the accumulated depreciation, and the method that is used. If we go to the Lowe's financial statements, we will see that there is a separate note that relates to property, plant, and equipment. So here they'll report in a chart form the useful life of items that they've classified as building and improvements. They can range from anywhere from 5 to 40 years. The historical cost, the accumulated depreciation, and they also talk about items that are leased. And in the significant policies, there will be a section that relates to property and depreciation, where they explain that they use the historical method, that they use the straight line method to determine depreciation for the period. So those are some of the required disclosures as we go through our financial accounting courses. When we state that disclosure is required, that means there are specific items that must be put into the footnotes.